Hello, everyone. We are now going to get into, my apologies there. We are going to get into chapter 8 again, part 2. So, the last one we got into in chapter 8 uh, was talking, let me think this through here. We were talking about diversification and management, strategic management of multi-business companies. Sorry, let me try to get this set up. Okay. So at any rate, we got to we got through, I believe it was slide 8. No, that is not what I wanted. Sorry. Okay. So we were talking about mergers, acquisitions, so to speak, when a company turns into, I don't want to say a conglomerate yet, but begins to grow through other resources other than organic growth. Okay. So when we're talking about this, we need to keep in mind the Ansoff matrix. We also need to keep in mind all of that information that we learned about in chapter 2, talking about that master strategy and tools worksheet and all of the rules that exist there. Okay. So the next question the book asks is, what about entering into a new line of business through internal development? When they say internal development, what they're talking about is starting a business from scratch. Now, it doesn't matter if you're starting from scratch as an entrepreneur to start a new business, or if you're a company that has lots of resources and you're trying to start a new business from scratch. Uh, a lot of the principles are the same, other than usually the one that is a large company that's doing it may have more resources and may be able to afford to lose a little more. Okay. But we have some things we have to keep in mind always. So I'm just going to read this off. This is a preface to the next slide, um, which is talking about getting into that new line of business. So achieving diversification through internal development involves starting a new business subsidiary from scratch. That's what we're talking about. Internal development has become an increasingly important way for companies to diversify. Corporate venturing or new venture development is the process of developing new businesses as an outgrowth of a firm's established business operations. It is also referred to as corporate entrepreneurship or even intrapreneurship, since it requires entrepreneur-like qualities within a larger enterprise. Okay. And we are, oh man, let me, there we go. Okay. Let's go back into our master strategy and tools. We'll jump back up because we need to remember some things. And one of those things has to do with the product life cycle and growth. Yep, this diagram again. So in this diagram, what we're talking about is when a company is trying to do this new venture thing, as opposed to buying a company that's already figured out how to do this, there's a very strong chance that either the cost of entry into this new business line is so high that it makes it so a company that has a lot of resources may just be better off trying to do it alone and not acquire that other company. Um, the other issue, though, and the more likely issue is we have change that happens so fast in our lives that uh, industries don't necessarily know what's going to come next. And if you don't know what's going to come next, it's a process where you can't, hindsight's not 2020 because you don't know what you're doing yet. You don't know what this looks like yet. And that again comes into this life cycle diagram is the people that you hire to do this, and that's what the book was talking about, are often different than the people that you want doing normal strategic management. Okay. You don't want a person that has scaled a company and grown it and achieved those economies of scale. That's not the same. I apologize here. I think I keep doing my S's, and I want to make sure I'm not, that isn't screeching in your ears. Sorry. Try to talk off center here a little bit. So the person that you have trying to achieve that, a very left brain mindset, is not the same person that you want in the when you're trying to figure out what's next. So you want transformational leadership and people that are willing to take risk. And not only are willing, but oftentimes they're good at it because maybe they've done it 3 or 4 times before. So in that process, it is very costly because you don't know how to do it yet. You may have to go find how to do whatever it is you're innovating. That means you got to go find people that know a thing or two about this. Um, for example, at a number of large universities in the 70s and 80s, we had this petroleum engineering. I was talking about Jack Welch. And, in 1940, nobody really knew how to make plastic. Somebody had to figure out and experiment with all this stuff, and that's very costly. So, one of the things that the industry would do is they would want to hire doctorates and PhD scientists that have experimented with plastics and have all the ins and outs of it and understand it to a great level to help either come into the company or share their research. It's a very creative action. This diagram calls it emergent. Then from there, you have to pick, well, we have all these options and ways to go. Which one should we try to bring to market and then sell it? And that is having to select one and then the entrepreneurial action of actually trying to sell it. So whoever is creating it may not even be the same person that you want selling it. Once you begin to sell it and you're sort of over and over and over again, then you figure out what to do and what not to do. That's when you implement strategic management, okay, or strategic planning. That's when you figure out how do we scale this to a higher level. I think one of the reasons I get so passionate about this one and why I love this diagram is because I've seen too many business managers that are brilliant strategic managers, but when they have to start going into this transformational phase and they're lost. And what they don't realize is just because you knew what to do when you were growing a business or you're growing a company doesn't mean you can do this other part because it's very uncomfortable for people. Give me 1 second here. Okay, my apologies. My daughter needed to ask me a question. We were talking about whoops. Okay, this diagram again. So these aren't the same people, and that's what we want to be aware of. All right, let me make sure we're back on it. Okay. So when you go through that process again, oftentimes if it's a large corporation, they may want the engineering manager dealing with trying to expand into that industry. Okay, so these are just some notes. Okay. Entering into a new business line organically or doing it yourself, not buying a company that's already done this, okay, makes sense. Yeah, we're going to go back to it. It makes sense when nobody has figured out in the industry where to go next, okay? If somebody's figured it out and they've been successful, then you have a follower leader strategy that needs to be implemented. Okay, so often it's more attractive to do it yourself when the parent firm already has the in-house skills and resources needed to compete effectively. And again, nobody knows what the next part of this is. So logically, this is you're having the engineering managers, the people that know the business best, working to do that. Two, there is ample time to launch a new business. When you are in a competitive landscape, right now we're watching this with AI and artificial intelligence is you have one group or one venture that went out or one can't think of the guy's name. Oh, I don't remember it. He's the guy that helped create Chat GPT, but you also had other teams that were being funded and financed in trying to create AI systems. Whoever got there first, then the other group, I don't know if they can dive in and try to copy what they're doing. I would assume all the programming is proprietary, but who knows? But once one figures it out, it's kind of like, oh, okay, well, then we're good here. We need to go to the next thing, and we're not sure what that is. But the reality is, nobody other than maybe some universities have the resources to put into something like this. Okay. Another one is the startup cost is lower than the cost of entry via acquisition. What does that mean? Well, if you saw that there's five or six companies out there that are doing what you're wanting to get into or what you're wanting to do, especially if you have a relatively new industry or new product or new thing that you're dealing with, um, it might be cheaper to try to do it yourself versus acquiring one of those other companies because maybe their profit margins are so huge, their earnings are so high that it you're paying too much. You're paying five times than what you can do it yourself. But the thing you have to remember is that there is a cost. When there's a cost to doing that, there's a learning curve, okay, that you're always dealing with. Another one, the startup will not compete against powerful rivals. Okay. Oh, hold on here. I feel like we got something wrong here. Oh. Boy, that's no, that's not. What, what they're saying here, oh, this is bad English, um, is a startup does not have the ability to try to compete with rivals because the rivals are too powerful. So yeah, that there's a verbiage problem there. Next, adding capacity will not adversely impact supply and demand balance in an industry. I was thinking about this last night, trying to come up with an example of that, and I just none is popping into my head. But you don't want to go into a market that's saturated uh, with other firms that are doing this. Okay. And lastly, incumbent firms are likely to be slow or ineffective in responding to an entrant's efforts to crack the market. So, in other words, the other firms are like, who cares if they want to do it? They can try to do it. We don't think they'll get there anyway, so it doesn't matter. Um, you do want to be aware of that, though, is if the startup can't compete with the other rivals that are in there, then you may have only no choice but to acquisition another company. Okay, now we talked a little bit about ChatGPT, and I said there's all these companies that had been funded by numerous groups, numerous company owners, entrepreneurs, the founders of companies. Bill Gates was one of them. I think Tesla or Elon Musk was another. Who these guys were funding money into multiple different AI ventures, trying to crack the code and make the perfect AI or whatever. Okay, when they do that, usually what would happen is like Chat GPT, it, and I forget what the owner of that is, but that venture that moved forward, they will begin their own company, and then the people that funded it, the venture capitalists that funded it, will get shares of stock in the company based on a predetermined uh, amount, usually in the contract when they gave up the money in the first place. The downside in the joint venture usually is you'll have a lot of those ventures won't make it. They aren't going to be successful. So again, that's why you have Bill Gates or Elon Musk putting money in multiple different ventures trying to do this AI thing. Okay. Um, so often you see these people going in, working with someone else to do a joint venture when the whatever they're getting into is way too complex for them to do it themselves, or it's uneconomical. Maybe the startup capital is so huge that no one company could do it. It requires multiple stakeholders. Or for some weird reason, it's very risky to go it alone. Maybe because a competitor or another company in the supply chain or the value chain is watching you do this, and it might make more sense to just say, "Hey, we're wondering about starting this new ABC and XYZ. Do you want to work together on that? We'll each contribute X amount, and then we'll own whatever company that spawns." Um, so they're trying to lower the risk because they would be afraid otherwise that maybe that other company is going to come at you aggressively and maybe you won't be able to be successful. Um, Another thing to note is the opportunities in a new industry require a broader range of competencies and know-how than an expansion-minded firm can marshal. Again, go back to the mental diagram on the master strategy and tools. There's a lot going on here and a lot of information required to do this. Starting a company or starting a venture like this is the learning curve is huge, especially the less you know about something. Um, all right, so some drawbacks to doing it yourself, or excuse me, doing a joint venture is you have conflicting objectives. It's possible that the parent, well, firm A and firm B that are joining together in a joint venture to start AI or something like that, they might want it for totally different reasons. Maybe one wants it because they want to go in this direction with the company, and the other is going in this direction, and there's not enough resources to go in both directions. Well, now what do you do? Does one buy the other out and then can't use the AI, or how do you deal with that? Another drawback is the disagreements about control, who's in charge, who's going to make the decisions. And one big one is culture clashes. And that's a huge one that in our merger and acquisition section is very often mergers and acquisitions fail because of culture clash. That in fact, that's probably the biggest reason companies or mergers fail is because it's like, well, what culture do we follow? Do we follow, the parent firm, or do we follow the target firm? Um, and when those cultures don't clash well, then it usually fails to materialize whatever successes are required in that venture. Um, your book's just talking about the difference between a related business versus an unrelated business. Now, we've already talked, and you know my opinion on this unrelated business thing. So, a related business that's actually pretty expansive most of the time. So, there's something in the value chain or the supply chain or a core competency or a sustainable competitive advantage that would mesh or match well with the current business, the parent business. Okay. So that's a related business line, and that's logical, that's rational, and I would say encouraged. But then you have unrelated businesses. So in unrelated businesses, you have value chains and resource requirements that are so dissimilar that no competitively valuable cross business relationships are present. Okay, now again, most business schools, the school of thought on this is you should not go into an unrelated business because and especially a business that has a different value discipline, because you'll get an absolute culture clash then if you imagine if you have two firms, both of them, one has 10,000 people and they're going after a seemingly unrelated firm with 1,200 people. It, if when they have to start working together because you're bringing one into the other, you're merging them or acquiring them. Um, if the target firm has a operational excellence, so they're a low cost producer and that's how they compete, and they're being bought out by a company that has a high customer intimacy or product leadership value discipline, you get managers that are going in totally different directions. And it's like, well, how do you handle that? How do you deal with that? And it takes time and it's painful for people. So that's why those mergers and acquisitions or going into any growth through a new business, when you go in the unrelated, it just doesn't work very well. Okay. And routinely fails. There's a slide somewhere I want to highlight. Okay, so your book's just talking about related business versus unrelated. Related business possess a competitively valuable cross-business value chain or resource matchup. Unrelated businesses have dissimilar value chains and resource requirements and no competitively important cross-business value chain relationships. We've gone over this over and over. So there's in the related business, there's something there that is a good blend or a good match. Unrelated, there just doesn't seem to be anything. And then your book, uh, this is a diagram you might want to keep for a test, but it talks about your strategic options. Diversify into a related business or diversify into an unrelated business, or do a strategy of both to try to grow. Um, Hopefully we get here somewhere. So when you get into the related business, it logically, I'm sure all of you can understand, you want to try to maximize and create synergy within the departments in the group where you don't, one plus one equals more than the sum of the parts. So it equals three or four or five or whatever. Ways that that's done is often requires a transfer of knowledge or resources or expertise or sharing costs or creating further revenue growth through sharing a brand. We see that a lot in like the dishwasher detergents, or not dishwasher, washing machine. Strategic fit, this is just the definition. Strategic fit exists when the value chains of different business present opportunities for cross-business skills transfer, cost sharing, or brand sharing. So we want to try to have a strategic fit. And here they just go through the value chain or the supply chain, value chain, value chain. They go through and say, okay, in these categories between firm A and firm B, do we have something that either we're both companies are good at together, or is it where you have a sales and marketing team that in the firm you're acquiring that is when way more successful than you have, and you both have a product leadership strategy. So then let that team of sales and marketing people maybe come into your department or your the parent company and say, hey, help us out here. We think this would work well together to have you guys lead this since you've been so successful in the past. So it's a melding and a meshing when you're creating that strategic fit. And then we talk economies of scope and economies of scale. Scope related cost savings stem from the strategic fit of the value chain of related businesses. So scope is, well, we're asking how do we operate the firm after the acquirement or after the organic growth or the venture that we went out in. Okay. Are we going to operate it under the same umbrella, or are we going to have two separate entities, but we're going to have shared interrelationships somewhere in the value chain? One of the advantages of making sure you have strategic fit in economies of scope is the greater the cross business economies associated with cost saving strategic fit, the greater the potential for a related diversification strategy to yield a competitive advantage based on lower costs than rivals. What on earth does that mean? It means that if there's a strong fit, you're probably going to come up or create or enhance a sustainable competitive advantage. That core competency or that value discipline melds well together, and now you've created something even better, bigger, stronger um, in that capacity. Um, I'm not going to go through economies of scope and economies of scale. Always remember economies of scale or the ability to do more as you get bigger. Economies of scope are kind of, well, what are we going to do here and what are we going to get good at versus what are we going to ignore? All right, so this is the one for the agent, the manager, the CEO, the person, the hired gun coming in to run the organization. Okay. When they look at going after these types of business ideas, this type of growth, okay, they want to do it. So when they do it, the stock price of the merged company goes up higher relative to the earnings than it would have otherwise when the companies were separate. That's what you're trying to achieve. In order to do that, it's not just necessarily the earnings going up, It's other business related things, or the business strategy, which is usually either achieving more sales or a cost advantage or something in there, thereby causing that stock price to go up. Now, here's the thing. If that doesn't happen, then the merger, the venture, whatever, however you try to do that, was not a real good deal because your stock price went down afterwards. And investors then probably believed that you were either incompetent or you didn't have sound logic when you went after this in the first place. Okay. So if revenue, or excuse me, if costs go up tremendously by merging, but revenue goes up many, 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 many times that, well, then that's a positive. You have higher earnings, you would have a higher stock price. If, on the other hand, costs go up and revenue stays about the same even after the merger, when you add both companies' sort of revenue streams, well, then you didn't create value and you're going to get fired. So that's why the strategic fit strategy, or strategic diversification and understanding these concepts is so important. If you're going to go run that company someday, you need to be aware that when you try to pursue this growth, what are the investors going to look at and want to see and want to make sure you're doing or not doing? So that's why the strategy thing is wildly important. Now, the other piece to this, in your book has it here and it had it in about ten slides earlier. It talks about when you get into a diversified strategy, or a diversified business line, and we'll say partially or fully diversified, you have to remember that if the stockholder, the owner, the principal, could have taken some of their money and gone and bought the stock of another company that's getting into that business line, and it would have been good and successful, well, then you, as the agent running the company, better not be, you shouldn't be investing in that, because the stockholder is the one that wants diversification, not you. The reason you might want to get into a diversified, a limited or partial diversified business line is because the stockholder can't go buy another company because maybe it's not publicly traded, or there's no business, private business that's for sale. They can't invest in that to diversify. So then it might be logical in a limited or partially diversified business line, then it might make sense for the stockholder, or for the agent, to get into a more diversified field, because maybe the principals, the investors want that. They want to get into that business line for one reason or another, and they can't do it by going and buying it themselves. The only way that it can be done is through the company that they own. Okay. So I know there's a lot there, but that again is the alignment of financial strategy and business strategy and understanding what you're trying to do. Okay. So you want to capture benefits that are possible only through, usually you only capture the benefits through a related diversification. Okay. So again, it goes back to the Ansoff matrix: partial or limited diversification. Okay. Fully diversified, completely, totally unrelated, the chance that you will achieve more by having gone that route is very slim. It's highly unlikely, but maybe the owner of the company wants that. Um, Now, just because you're going into something related doesn't automatically result in benefits. Um, Management still has to go in and do a fair amount of work to create those benefits and to create those synergies, in the process, or even in the business line. You're still working hard for all those things. Book talks a little bit about Kraft and Heinz merging and some of the issues and problems they had there. It mergers and acquisitions go through cycles. Um, I want to say in 2004, 5, 6 time frame, in the late 90s, you were watching all day long companies merging and getting acquired. In fact, one of the biggest ones was Citibank and the Travelers Group which was their merger was actually illegal. The federal government had laws on the books that said an insurance company and a bank can't merge. And they did it. And how they did it is they had plenty of money, so they lobbied Congress and uh, whoever else they had to lobby to get the law changed to allow them to merge. Now that's kind of scary because that's how much power, financial power, especially that they had. Okay, now your book talks about getting into an unrelated business. Again, I'd love to ask the authors define the line of unrelated because they have a pretty bold definition of it, which is there is no relationship in anything whatsoever. Um, One of the reasons that the company would want to get into an unrelated business, again, has more to do with the shareholder. And it's because the shareholder maybe can't get that business growth in that industry on their own. And if they can't do that, and then they work through their company and the agents of the company that they own to do that, then you're okay. Because it has to do what's called principal and agency theory. Okay. Principal is the owner investor, the agent's the person hired to run the company. When the principal wants something, they own the company, so they kind of get what they want. If you, as an agent, are not doing what they want, you get fired. So that would make sense if the principal wants to go into a certain direction into an unrelated business line they might want to do so, and then they want their agent to go through and do something like that. Well, then the CEO, the agent's okay because they're doing what the stockholder wants. What you don't want to have happen is the principal may not want to diversify. If they want to diversify, they'll go do it themselves. And the company says, well, I feel like we have too much product in one industry, and that one industry might be going kind of down. And I don't know, I think we should try something else. And then they get into something like we talked about yesterday with General Electric and Pizza Hut. Okay. General Electric doesn't understand anything about the food business. Why would they get into Pizza Hut? Okay. Totally unrelated business. There is like almost no similarities there. Um, in that scenario, if General Electric went after Pizza Hut, the principals, the investors of that corporation would look at the agents as if they were on crack cocaine because you can't do that. You're not supposed to do that because that defeats the whole purpose of business, which is to get better and better and achieve economies of scale and scope as you grow and you get more big and powerful through whatever your business strategy is. Okay. Um, So uh, they're defining a totally unrelated business where no strategic fit exists. There's no meaningful value chain relationships, and there's no unifying strategic theme. Um, Again, even if you're looking at that, you want to do that three question test, which eliminates then usually the unrelated business line. So again, that's why I don't really like the textbook version of this is it's kind of like a trick. Actually, give me 1 second. We'll go back to the three question test. Okay, I did find it. So on number slide 4 and 5, 4 was a slide I added um, because I wanted to have this lower area up on top so you guys would read it. Um, it. To get into an unrelated field, an unrelated business line, um, they said you still need to do that three question test and that three question test talks about the value of the shareholder. Okay. That's what it's related to. That's why I don't like how the authors are kind of discuss this section because they're saying, well, yeah, you could get into an unrelated business or an unrelated field. And it's like, no, no, there's only one time you get into a completely unrelated business line, and that is when the investor class, the owner of the company, is telling the agent to do that. Otherwise, you don't do it. Because why? Because the principal will look at the agent and say, what are you doing and why are you getting into such an odd, unrelated business line? Get out of here, you're fired. Okay. So this has very little to do with the agent who's running the company, and that's the people that usually get business degrees or the people that want to run the companies. So the three question test that they talk about, if you want to get involved in an unrelated business, you still need to go through these three tests. One is that industry attractive? Um, the industry you're looking at getting into offers equal or better profit and return on potential investment opportunities. The cost of entry test is it makes sense to do it. It's not so horrifyingly expensive, especially if you're doing it yourself, or if you're buying an existing business that's in that business line. They don't have such a premium on their valuation that it doesn't make sense, and you're not going to be able to make money off it. And then the better off test is the firm's business will perform better together than as two standalone firms, where you've created that synergistic benefit where 1 plus 1 equals more than the sum of the parts. Okay, that's the only real theoretical justification for going after a business like this. So we can see here when it says getting into an unrelated business line, it's basically saying unless the shareholder, the owner, the stockholder is telling you to get into an unrelated business line, don't do it, stay away from it. Unless you have a really, 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 really good reason that is so brilliant that everybody would hear it and say, oh, yeah, 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 you know what you're talking about. That's a good idea. All right. Um, Here we're just talking about who you would want to go after in a merger acquisition into an unrelated business. Uh, Other things that you would want to pay attention to would be those firms that would have high growth prospects but short on investment capital. Um, in other words, this actually goes back to the rules of mergers and acquisitions. So if you understand that, you don't need to worry about this. Undervalued firms that are acquired at a bargain price. Struggling firms that can be turned around with parent firms' financial resources or managerial know-how. Okay. So that, though, would seem to indicate that there would be, well, financial resources might could happen with an unrelated business diversification acquirement. Okay. But here they just said managerial know-how. Okay, what does that mean? Well, that's a good theoretical justification of getting involved in something. You have something related. Okay, you have a management team that can teach the other company or business in the unrelated field how to manage differently and maybe run the company better. Now, here's the problem with that idea. If we go back and we go to the end of our master strategy and tools, somebody asked me the other day, how do you come up with the names of all this stuff that you create? And the answer is, I don't know. Sorry. Okay, in the merger and acquisition, here are some bad reasons firms get acquired. Diversification into product line portfolio. Okay, fully diversified. Then another one is management hubris. So here's the question for you. If Oh, God. Sorry, guys. There. So, if the management of the parent firm can help aid the management of the target firm, okay, in the unrelated business line, how do you know if there's actual real managerial know-how that can be shared with the struggling firm who happens to be undervalued, who has high growth prospects, but nobody sees it. So nobody's like, it's just a true unicorn in the world. How do you know that the managerial know how isn't, hey, one sec there, management hubris. How do you know that? And the answer is you don't. So you got a little bit of a problem. One of the bad reasons to acquire a company is management thinks they can come in and fix everything. So one of the questions might be is, well, has this management team come in and fixed a company like this before? And if they have, well, then maybe you're not in a completely unrelated field. So I don't know about you guys. I just think this stuff is so interesting because you would think, I guess, management is an art, but watching all of the mergers and acquisitions out there, and there's books upon books written talking about this stuff, you would think we'd get to a point where we're narrowing this in, but we still have very intelligent folks telling us, well, no, there still is a chance. And it's like, well, wait a minute, though. The chance isn't very good. Do you really want to go down that pipeline? And then once you understand that and you read through these PowerPoint slides and what the authors wrote in the book, then you can start looking through it with a critical lens. You're like, oh, that's sneaky. You're hiding little like ifs or what ifs or hey thens that should be almost have their own PowerPoint slide. They're that important, but then they're kind of hidden. I don't know. I think that's really interesting. Um, so if you're trying to get into an unrelated business line, how do you create shareholder value? So your book talks about do a superior job of identifying and acquiring new businesses that can produce consistently good earnings and returns on investment. How do you know if it's an unrelated field, if that's going to continue? And the answer is, how long have they been around? Okay. How long has this target business that we're looking at been doing business? If it's 40 years and they have 40 years of experience of growth and high growth at that, maybe it's a franchise. Maybe it is. I don't want to use pizza because they're shrinking. And I don't know. Maybe Jimmy John's is a growing sandwich company. I don't know. I know Subway is also shrinking as well. But if you have a Jimmy John's, and for the last 25 years, every year Jimmy John's has grown by 20% year over year over year for 20 years, well, then you may have a solid uh, product or a business that you're getting into that's unrelated, but it has a very strong um, history. That's the word I'm looking for, history. Uh, Next one, how do you create shareholder value in an unrelated firm? You do an excellent job in negotiating a favorable acquisition price. Now we're gonna do it again. I'm going to go in and show you what an overvalued company uh, acquisition, how you figure out that number for that, which again to me is that's like the cool stuff of business. So I am going to hit pause here. Okay, so we're going to go do a quick valuation of Tesla. So let's say we're Ford Motor Company. We'll pretend like we have an interest of getting into a better area in the electric car market, and we have so much money sitting around that we can probably do it. Okay. That doesn't mean we should do it. It just means we could do it. So, in order to do this, we're going to start with we have to do a stock valuation of Tesla. So in order to do that, we use the capital asset pricing model. So first number we need is a risk-free, or excuse me, a return available on a large cap company. We get that from the Ibbotson and Associates folks, and for large cap stocks, and Tesla is a large cap company, the historical annual rate of return is 10.4%. So we go into here, we enter in 10.4. Then we need a risk-free rate. We get that from a 10-year treasury bill, and right now that is 4.39. So we're going to get frustrated. There we go. Go 4.399. Next, we need to figure out the risk of Tesla. And I need to shrink that just a little bit. There we go. Okay. So if we go into Yahoo Finance, Tesla, and we look at the beta coefficient, holy buckets, we got a boatload of risk here. So we have $2 and, or excuse me, 2.46. So a beta of one exactly is the same risk of the market. Above one is more risk, below one is less risk. And negative means that when the market's going up, the stock is going down. When the market is going down, the stock usually is going up. Okay, so 2.46. So we're going to go into our capital asset pricing model, type in 2.46. Then we're going to hit calculate. We get a risk adjusted discount rate of return of 19.17%. Next, we have to do a stock valuation. We have to figure out what should the value of Tesla stock be based on a law of averages. So the first thing we need is the earnings per share for the trailing 12 months, and that's $1.74. So you're paying $322 to receive $1.74. So we go in here, we hit 1.74. Earnings are expected to grow at a rate of, we go over to Seeking Alpha, and the one that we want to look at for this is this free cash flow, so 17.84%. So Tesla is expected to grow by a fair amount as of today, okay? And I forget, I always do this. In class, I give students a worksheet so they can write all this down, and that's because I created a worksheet for myself because I kept forgetting these numbers. So 17.84, you guys need to remember that. We're going to type in 17.84, expected to grow for the next 5 years until leveling off. Now, I'm going to take a guess. A leveling off rate, usually we set to inflation because all companies come back to like regular at some point. What goes up must come down. I would say Tesla might be, they're a really weird company because they might be in a position where the investment to do what they're doing was so great, and the only reason you would do that is if in another 20 years, almost every other person driving a vehicle will be driving a Tesla. That's the only reason that would make their investment worthwhile. So we're going to assume that not everybody today drives a Tesla, but more and more and more and more and more people are going to do that. So I'm going to level them off to 4%, okay? Because they've been around for a while, but I think they're still going to be growing by a fair amount. So we discount this, all of this information by 19%, and that's going to give us our stock price, what we think the value should be. So we hit calculate, and the stock price should be $19.69 a share. What is it? $322. So we have a horrifyingly overvalued stock. And people would say, oh, yeah, but it's supposed to grow by more. No, the analysts have already figured this out. Guys, these growth rates are, those are the analysts saying, even, even with all of this growth in the future and great things and everything else, if you add all that in and figure all that out, it still is not worth $322. Okay, we think it's only worth $19.69. So if we're Ford and we're going to go after Tesla, I did this as an extreme case. The negotiators are going to want to offer up per share far less than this amount. They're probably going to want to offer up something under 19.69%, which is the valuation price. Okay. That's what they're going to want to do. They want to get it underneath there. And then that gets into a strategy because if the negotiators can't get that lower than that $19.69, then the Ford stockholders are going to say, then it's an overvalued company. It's not worthwhile to invest. We can invest in 27 other companies and get average rates of returns. That's not the purpose. We want to get it at a lower price or at least at an accurate valuation price, which is that $19.69. Okay. So again, this is kind of the cool thing. So that's how they do it. Now, granted, when their internal finance people do this, they do it, but they also have like Goldman Sachs run the numbers as well to figure out, well, what is this really worth? Because there is no valuation police. You can invest in anything for any reason you want. I can go buy Tesla stock tomorrow. Doesn't matter if it's overvalued. I'm perfectly able to do that. Nobody's going to call me up and say, sir, you invested in an overvalued stock. We have to arrest you now and you have to give back all your stock. That's not going to happen. So, but when you're in the world of investing and finance and mergers and acquisitions, if you're not going to use that, well, then what else, what other way would you use to figure out if this is a good deal or if it's an undervalued investment? And the answer is, well, whatever that is, then use it. And maybe if it works and you do it over and over and it continues to work, then keep doing it that way. But if somebody figures that out, they're never going to share it with the rest of us. And we have people that have tried to figure that out. They're called quants, black box hedge funds in Wall Street by created by NASA engineers that think they have a formula. Well, they're going to guard that formula with their life because once everybody figures out that formula, well, then they don't have anything of value because everybody's going to do it the same. They're going to run the numbers the same way. So in the stock valuation, the same thing is true. Is it's like, well, if you didn't use that, what else would you use? So when if the executives are trying to buy an unrelated diversified company, they want to get it at the valuation price or less than the valuation price. So what they want afterwards, let's go back into our master strategy and tools. I'll give you I don't want to go through the numbers with this because I don't want your eyes to glaze over. So when they're doing this, when we just did this, if we're Ford and we know that the appropriate price for Tesla stock is $19.69, then our least acceptable offer would want to be probably that $19.69 or maybe even slightly less. As Ford, that's our least acceptable outcome. Our most preferred outcome might be getting it for $10 or whatever whatever they think is the absolute best price you're ever going to get. That would be so if we're Ford, we give our MPOs and our LAOs, and then we know usually the negotiations should land there after a little while. Tesla, on the other hand, wants to put their most preferred outcome. It might be $322. Their least acceptable might be $19.70. Okay. So that's how we set those MPOs and LAOs. And whoops, I think I passed it. So there's only one real theoretical justification for a merger acquisition of this, and that is this diagram, this formula, which is the present value of all the firms together. Okay, so the value, if we did a valuation for Ford, we did a valuation of Tesla, and we added up those by a weighted average. And then once we're combined, we figured out how much cost savings are we going to have by firing all the HR people and the payroll accountants because we don't need those at Tesla. We're going to save $10 million. So then we add up, again, the valuation price of us, of Tesla, of the cost savings. And what we're saying is that should equal more than if each of those was separate. Okay. So the present value of the acquired firm or the acquiring firm, the present value of the target firm, and the synergistic benefits. If those are better off separate or is more separate, then you should not go through with the acquisition. So the company has to get a good deal on that. Otherwise, they just don't go through with it. And it's always said in business or in negotiations, if you can't afford to go into the negotiation, then you shouldn't be negotiating. Okay. Another option for a company investing in an unrelated firm or business and trying to create that shareholder value is that you do such a good job of overseeing and parenting the new firm's business that they perform at a higher level than they would otherwise be able to do through their own efforts. So you've increased efficiency and effectiveness at a very high level. Now, that's where you run into a number of different problems. If you're General Electric and you have your engineering managers come into Pizza Hut, maybe they would make it more efficient. But I would argue Pizza Hut's probably already pretty efficient. I don't know what you would actually put or change in there to make it even more efficient, but maybe there is a way to do that. Okay. Or you have management hubris who thinks they can do that, but the chance of actually doing it might be slim to none. All right. Um, Now, finally, getting to the good stuff. Here are the pitfalls of going into a unrelated diversified business acquisition or business growth, um, organic, go into something from scratch. Okay, so it demands managerial, or excuse me, some of the pitfalls and the demands on the manager. They have to stay abreast of what's happening in each industry and each subsidiary. So here you start understanding there's a knowledge problem. Okay. There's a knowledge problem. It's like now somebody has to be an expert in more than one industry. And is that possible? Yeah, maybe. But if the average manager in the average Fortune 500 company, S&P 500 company, works 68 hours a week, and you add 10 hours because now they have to become a master in an industry they know nothing about, you don't got a lot of people that want to do that. That's kind of where you see like Elon Musk doing things, is he's willing to do that when others aren't. Uh, you need to figure out how to pick the right leaders, the business unit heads having the requisite combination of managerial skills and know how to drive to gain performance or performance improvement. Tell the difference between those strategic proposals of business unit managers that are prudent and those that are risky or unlikely to succeed. Think about that for a second. So, what we're saying is if we're General Electric and we're going to go buy Pizza Hut, and you have the unit managers that are running Pizza Hut, maybe you hired the people that were running Taco Bell and you brought them in and said, "Here, we want you to run Pizza Hut." And they're doing it. If you're an engineer, we'll say a petroleum engineer, will be Jack Welch at General Electric. How are you going to know if the ideas that the new people that are running Pizza Hut, how do you know if their ideas are going to be risky or not risky? Do you see how much knowledge and information you need to possess in order to prevent or to make sure that's not happening? That again is why getting into an unrelated industry, it just doesn't work. Okay. Because then if you're leading this, you're in charge of the company that's doing this merger acquisition or this business line. Are you gonna, how are you gonna know if they're full of crap or they're not full of crap? Okay. Now, yes, we have the internet. You can do some research or ask AI, but that doesn't mean that their ideas maybe still aren't a good idea. And you're going to decline it because you're like, no, that sounds stupid. And then you see some other competitor that does it and rocks the world. Knowing what to do if a business unit stumbles and its results suddenly head downhill. What do you do then? Do you divest it? You sell it off and get rid of it? How do you handle it? Other pitfalls, this is the big one. And again, this is all based on knowledge. There's a limited competitive advantage potential, okay? Because you're in something unrelated. So, unrelated strategy offers limited competitive advantage beyond what each individual business can generate on its own. Without that strategic fit, consolidated performance of an unrelated business is unlikely to be better than the sum of the individual business units could achieve independently. What does that mean? It means most of the time, this formula is if you're in an unrelated field, they're probably better off separately operating. And if, unless the investor of owning the parent firm says, go target this other firm in that industry, well, first, that means that the investor would have to possess it or not have a way of investing themselves into a diversified business. And if they can't do that, then they tell the agent of the parent firm, go buy this other company and start going in this direction. But if the investor does not say that, then 9 out of 10 times it's not worthwhile to get into an unrelated business venture. Okay. Either through acquirement or through starting from scratch. Okay. So again, in fact, I'm going to do this now. We're going to turn that into red font. We're going to blow it up. We're even going to turn it into Arial black. And I'm going to put an exclamation mark because that's how important that one is. Okay. There usually isn't a strategic fit. There might be, but there usually isn't. Therefore, it's often not worthwhile. Here, misguided reasons for diversifying. This might be the other bad reasons. Now, this one kills me a little bit because I don't think the book does a good job of, well, yeah, let me say that. Here are misguided reasons for diversifying in an unrelated business line. Managers would say, "Well, we're gonna go into this to reduce our risk, because if we're General Electric, maybe Pizza Hut, they've been doing it for 50 years. There's not a lot of risk in what they're operating, so maybe that's a good place to put our $10 billion that we're sitting on. We'll just go buy Pizza Hut. It's low risk and not great return, but they know what they're doing. They know how to do it, and that's where you get into the big rule. It is not the agent's job to manage, to diversify. Let's just leave it at that. I was going to say to reduce risk. They are to reduce risk, but they're supposed to be doing it in the ways they know how to do it. The agent of General Electric does not know how to, they don't know how to reduce risk through that. Okay, that's done by the principal. Another reason is because you're trying to grow. Okay. If you're trying to grow through an unrelated field, probably not going to work real well. Now, everyone accepts you have to grow. Okay. You don't really have much of a choice. You do that via competitive advantage or sustainable competitive advantage. But growth for growth's own sake is not a good reason to get again into an unrelated uh, business line. Trying to stabilize earnings. Now, again, you'd think these are all good things. You don't do that by getting into unrelated fields. And then you have those managerial motives, which often go back into bad reasons to acquire a firm. Not trying to diversify. You have management hubris. You have leaders trying to build their empire because the more people they oversee, the more money they get paid. Um, Excuse me, that's separate from empire building, but they kind of go hand in hand. All right. I think we're going to go ahead and stop here. So we're going to have to do a part three. Um, yeah, I need a break. So, all right, we'll go ahead and stop here. We're on chapter 8, slide 29 when we come back, and I'll see you hopefully in a little bit.